Listen to me. I am not showing you market static wild speculation or viral clickbait headlines. This is raw COMEX delivery data ripped from the beast's belly, revealing exactly what the banking cartel desperately hides from us serious stackers. Over the past 48 hours, silver breached a critical level that history proves triggers a total system fracture. It does not just simply bend, it breaks down hard right now. We specifically warned China's export ban would snap global supply chains. We warned paper derivatives and physical metal had decoupled completely. We warned the commercial shorts were trapped by their own leverage. But those warnings do not match the 2:30 p.m. Eastern event. Because what went down was not a typical market reaction. It was a highly calculated, coordinated bank raid. The delivery data from the COMEX marks a structural shift, the sort that only appears once every few decades. This is the footprint left behind before price discovery turns violent, before confidence evaporates, before the paper fraud collapses. If you have studied the charts long enough, the setup is unmistakable. The ghost of 1980 just walked back onto the floor, and it is carrying real physical metal, not empty paper promises. This is not industrial demand. This is not hedging behavior. Factories do not wake up on a Friday afternoon and demand millions of ounces of silver immediately. This is a bank run, a coordinated, aggressive grab for real assets while they are still priced as if nothing is wrong. And that timing is not accidental. The China export ban did not spook the market. It effectively lit the fuse. You are witnessing the early phase of a physical divorce. Paper trades still flash on screens, but the real market is moving underneath quietly and irreversibly. When that happens, prices do not adjust smoothly. They gap up hard. And the people who wait for confirmation are always the ones left staring at empty shelves and broken charts today. In this chapter, I want you to understand one thing clearly. This is not about predicting a price. It is about recognizing a regime change. Once you see it, you cannot unsee it, and by the time it becomes obvious to everyone else, the real opportunity is already gone. If you want the next chapter where we break down the exact numbers and why they matter, type A1 in the comments to continue. If you want to pause here, please type 2. And before we move on, make sure you subscribe to the channel and comment 1 below so the algorithm knows this conversation matters now. Let us remove emotion and focus strictly on the data because numbers reveal intent in ways words never can. And the delivery numbers released by the exchange confirm one thing clearly: this was not a normal trading session. It was a deliberate extraction of pure physical metal. On Friday alone, the exchange issued 1,168 delivery notices. Each contract represents 5,000 ounces of silver. That translates to roughly 5.8 million ounces demanded for immediate delivery, not rolled forward, not cash settled, not shuffled between accounts. Delivered, physically removed from open circulation. But the real signal appears when you widen the lens. Combine that report with the spike recorded the day before, and in the first 2 trading sessions of the year, a total of 3,446 contracts stood for delivery. That equals more than 17 million ounces of physical silver demanded in exactly 48 hours. To understand how extreme this is, consider global production. The entire mining industry produces roughly 800 million ounces per year. In 2 days, the exchange was forced to release over 2% of annual global supply. That does not happen in a stable market. It does not happen because of optimism. It happens when participants believe supply risk is truly immediate. This was not commercial hedging. Factories do not demand millions of ounces on a Friday afternoon. This was a strategic withdrawal of metal from the system while it was still available at paper prices. And the timing matters. January 2nd was the first real trading window after the China export restrictions went live. Anyone with visibility into supply chains understood what that meant well. When supply tightens, the first move is never price. The first move is possession. That is why there was no hesitation, no testing, no gradual accumulation. Delivery was demanded at scale immediately. Nearly half of the registered inventory was stripped out in 2 sessions. At this pace, the exchange does not have weeks. It truly has days. This is how market failures begin, not with panic headlines, but with quiet, relentless inventory removal, while spot prices pretend nothing is wrong. Now that we understand the scale of the withdrawal, the next question is the most uncomfortable one: who was forced to give up the metal and who had the power to take it? Because this is where the story stops being about silver and starts being about survival inside the global banking system. Under normal conditions, bullion banks play a paper game. Metal is passed back and forth on balance sheets, issuer to stopper, bank to bank, with no intention of removing anything from the vaults. It is a closed loop designed to maintain liquidity and suppress volatility. The metal circulates, but it never leaves the room at all. That is truly not what happened here. In this event, the loop was broken. One major institution was pushed into a position where it had no choice but to deliver millions of ounces it would normally protect at all costs. This was not voluntary selling. This was forced compliance. When the music stopped, one bank was left holding the obligation, and the obligation had to be met in pure physical form. On the other side of the trade stood institutions that used to be allies. The same banks that once cooperated to keep prices contained were suddenly competing for the same shrinking pool of real inventory. This is cannibalization. The unwritten truce was broken, and the behavior shifted from coordination to total conquest. When you study issuer and stopper data in events like this, you see intent with disturbing clarity. The buyers were not hedging. They were consolidating. The metal did not circulate. It moved in a straight line out of one vault and into another, never to be offered back to the market at current prices today. This is what happens when confidence in currency erodes. Participants stop optimizing for yield and start optimizing for control. The objective is no longer profit, it is insulation. Whoever holds the real metal holds the leverage. This moment marks a transition. The suppression model depends on cooperation. Once cooperation fails, the structure collapses from the inside. What we are witnessing is not a squeeze driven by retail enthusiasm. It is a war between balance sheets fought with physical assets instead of contracts today. Once the battle turns inward at the wholesale level, the impact always spreads outward. Retail never leads these events. Retail absorbs them, and the hours following the bank raid made that cold reality impossible to ignore. When banks drain exchange inventory, the effect is immediate. Mints lose access to industrial bars. Dealers lose access to product, and by the time the public notices, the shelves are already empty. This is not theory. It is a mechanical chain reaction, and this time it unfolded at digital speed today. Major bullion dealers saw inventory vanish almost simultaneously. Products that are normally available in volume disappeared without warning. Buy buttons were replaced with notifications. Estimated delivery timelines jumped from weeks to months. That is not a shipping delay. It is a sourcing failure. Dealers no longer know where replacement metal will come from today. This is where the spot price illusion breaks. Charts continue to print, but physical pricing detaches. When metal cannot be replaced, price becomes meaningless. Dealers stop accepting orders not because demand is strong, but because default risk becomes real. Taking money without metal is truly fatal. For the few outlets still showing inventory premiums surged. Not out of greed, but fear. Pricing shifted to replacement cost, not spot. Dealers are bracing for the next wholesale call to go unanswered or answered at a much higher number today. This is the moment bifurcation becomes visible. Institutions secure metal at one price through scale and access. Individuals face a different market entirely if they can access it at all. Wholesale closes down. Retail is rationed. When this happens, the window is already shut. The metal has moved, the system has tightened, and valuation takes a backseat to true ownership. The final confirmation comes from the vaults because inventory data cannot lie. Prices can be managed and narratives can be shaped, but metal counts reveal reality, and the end-of-day reports confirm the damage was already done there. The registered category. The silver actually available to meet delivery demands took a direct hit. In a single session, millions of ounces disappeared. This was not a paper shuffle. The metal did not simply change owners and remain available. It was removed from circulation, either reclassified as unavailable or physically withdrawn away. That distinction is critical. Eligible inventory is not for sale. It does not settle contracts. Once metal leaves registered status, it effectively vanishes from the exchange. This is how supply collapses quietly without immediate spot price response. When you connect issuer data, stopper data, and the net inventory change intent becomes obvious. The buyers did not take this silver to trade it. They took it to secure it. These ounces are unlikely to return to the market at current prices if they return at all today. Speed is the real killer here. With withdrawal rates this high, registered inventory has mere days of coverage left. The buffer is gone. Zero room for error now. When we cross that line, delivery stress becomes totally inevitable. This is absolutely not an isolated event. The metal drain is global. When multiple exchanges bleed out at once, arbitrage dies and fresh supply vanishes. The market shifts from simple pricing mechanisms to strict rationing. Vault data is the real smoking gun here. It proves this isn't speculation. It is pure depletion. Now we hit the point where this stops being dramatic and starts being mathematical. Markets ignore emotion, but can't ignore arithmetic. And the silver market's arithmetic simply does not work anymore. On a daily basis, the world produces a fixed amount of new silver. Mining output is slow capital heavy and ignores short-term price signals. You cannot double production just because demand spikes. You extract what the ground allows. That reality sets a solid, hard ceiling on all supply. Meanwhile, visible inventories are draining at a rate far exceeding daily production. Western exchange vaults drop millions of ounces daily. Eastern stockpiles are drawn down just as aggressively. Combine those outflows and the system consumes more physical metal than it can ever replace. This creates a major structural deficit, not a temporary shortage, not a logistics delay, a real imbalance where demand for immediate delivery beats the system's physical capacity. Once that condition exists, the market enters a non-linear phase. Small changes trigger outsized consequences. At this stage, price is no longer the balancing mechanism. Price works only when supply can respond. When supply is fixed and inventory shrinks, the only remaining adjustment is exclusion. Some participants are simply forced out now. This is why access is tightening so rapidly. Large institutions with standing relationships move first. Industrial users pay whatever is required. Everyone else is pushed to the margins. The market does not crash. It simply stratifies layers. This math explains the urgency behind the bank behavior we witnessed. They are not speculating on upside. They are front-running scarcity. They understand that tomorrow's dollars might buy less metal or maybe none at all. Once deficits become visible, the endgame accelerates. The system does not gently rebalance. It locks. And when it locks, holding possession becomes the only currency that actually matters. At this stage, many people ask the wrong question. They look at the chaos and ask whether the banks are about to fail. That instinct is understandable, but it misses the real threat entirely. This is not a solvency crisis. It is an availability crisis, and the difference is truly everything. The largest financial institutions do not run out of currency. They create it. Their balance sheets are protected by liquidity backstops, central bank facilities, and unlimited credit creation. Measured in dollars, the cost of acquiring millions of ounces of silver is trivial to them. It does not threaten their survival at all. What they simply cannot create is metal. That is why the recent behavior matters. The banks were not forced to act by financial stress. They were compelled by physical constraint. They saw inventory levels collapsing and understood that once the metal is gone, no amount of currency can bring it back at strictly controlled prices. This is where the power dynamic shifts. Those who control physical supply gain leverage over those who rely on contracts and promises. Paper claims lose relevance when delivery risk rises. Confidence erodes quietly, then abruptly all at once. This is also why the retail buyer is not the adversary here. The battle is being fought above them. Balance sheets are being repositioned. Alliances are breaking. Institutions are securing lifeboats, while the system still appears quite calm. And this creates a dangerous illusion. The absence of a visible crash makes people complacent. But structural breakdowns do not announce themselves with sirens. They reveal themselves through behavior, and the behavior we are witnessing is defensive accumulation at a massive scale. This is the moment when the market stops rewarding patience and starts punishing delay. Those waiting for clarity will find the door closed. Those waiting for a dip will find nothing to buy anywhere. This is where most people get trapped, because they keep looking at the wrong signal. They stare at the price chart, waiting for confirmation, waiting for a breakout, waiting for a pullback that feels safe. But in a market like this, price is the very last thing to tell you the truth. Price only functions as a signal when supply is elastic, when producers can respond, when inventories are deep, when contracts can be honored without stress. That world no longer exists here. What you are watching on the screen is a reference number, not a true clearing mechanism. The real price of silver is being discovered off-screen in private transactions, in long-term contracts, in desperate phone calls between buyers and suppliers. It is being discovered through premiums, delays, refusals, and silence. When dealers stop quoting, that is price discovery. When product disappears, that is true price discovery. This is why two people can see the same spot price and live in completely different markets. One operates at scale, moves truckloads, and secures supply. The other clicks refresh on an empty product page. Same chart, totally different reality. In these conditions, volatility becomes misleading. A paper dip does not create opportunity if physical supply cannot respond. Lower numbers on a screen do not conjure metal into existence. They simply transfer remaining supply to those who can act the very fastest. This is how markets transition from speculative to strategic. Price stops being an invitation. It becomes a warning. It tells you who has already moved, not who should move. Understanding this shift is critical because it reframes every decision. You are no longer asking whether silver is cheap or expensive. You are asking whether it is available at all today. When a market enters this phase, strategy changes completely. This is no longer a game of timing tops and bottoms. It becomes a question of positioning, patience, and restraint. The rules that apply in liquid balance markets stop working when scarcity takes over control. The first mistake individuals make is trying to outsmart institutions on speed. That is impossible. Large players move with privilege access, standing supply agreements, and balance sheet leverage. Competing on reaction time only leads to overpaying or being locked out entirely now. The second mistake is overexposure. Scarcity environments reward preparation, not desperation. Chasing every headline, every spike, every rumor increases risk. The goal shifts from maximizing returns to preserving real optionality. In markets like this, discipline matters more than conviction. You plan entries, you accept partial fills, and you avoid forcing decisions under pressure. The people who survive these phases are not the loudest or the most aggressive. They are the most self-controlled. Another critical shift is time horizon. Volatility compresses time. Moves that once took years unfold in weeks. That does not mean you trade more. It means you think further ahead. Short-term noise becomes irrelevant compared to long-term access now. This environment also exposes the danger of leverage. Scarcity amplifies downside as easily as upside. Forced liquidation is fatal when replacement supply does not exist. Staying unlevered is not conservative, it is actually strategic. Above all, understand this. When institutions reposition, they are not doing it for tomorrow's price. They are doing it for the next regime. Aligning with that reality means thinking less like a trader and more like a true risk manager. This brings us to the endgame. And the lesson is simpler than most people expect. What we have witnessed is not a prediction. It is confirmation. Confirmation that the silver market has crossed from abundance into constraint, from theory into physics. Once that line is crossed, behavior changes permanently now. The core lesson is this: markets do not break when prices rise. They break when trust disappears, and trust disappears when delivery becomes uncertain. That is exactly what the data has been signaling. The delivery spike, the bank-on-bank conflict, the retail blackout, and the vault drain are not isolated events. They are a full sequence. For individuals, the mistake is thinking this is about winning. It is not. It is about not being forced into bad decisions. Scarcity punishes impatience and rewards preparation. It rewards those who act deliberately, not emotionally. The goal is not to chase moves, but to avoid being trapped when access truly vanishes. Another lesson is psychological. When paper prices and physical reality diverge, confusion sets in. That confusion causes hesitation. Hesitation is expensive. The institutions that moved did not wait for headlines or confirmation. They acted on inventory data, supply signals, and simple math. And finally, understand this clearly. This is not a call to panic. Panic benefits no one. This is a call to awareness, to understand that regimes change quietly, then suddenly. And when the change becomes obvious, the options narrow down fast. Markets always give signals before they give consequences. You've just seen the warning signals. If this analysis helped you see the market more clearly, make sure you like the video, subscribe to the channel, and share it with someone who still thinks price alone tells the full story. And I want to hear from you. Comment below with your perspective on where we are in this cycle now. Stay grounded, stay disciplined, and remember this above all else: when systems strain, physical possession beats prediction every time.